Thank you so much, Bhagvi. A very, very warm good morning to one and all present here. Professor Nirmal Raj, Professor CMA Ravichandran sir, the very respected Dugar sir. I saw Dr. Hema Narayanan also over there. And I also want to personally thank Sudhirsha for a very detailed introduction. So thank you so much, Sudhirsha. It's a pleasure to be addressing at this very, very respected forum and so many bright young faces. I see many senior people also here on this very important topic. I think one very important thing, which I am sure both Ravi Chandran sir, Nirmal sir, and most of the seniors who are present here today will all agree with me is the education in India is wonderful. You take your schooling, you take your college, you take wherever you study, you learn a variety of things. You become a doctor at a younger age compared to other countries. You can become a chartered accountant or a lawyer, whatever you want, you can become, and you'll be thorough in all the technical matters. But nowhere does anybody teach you financial literacy. I am earning some money. What should I do with the money? You are not taught anywhere. I'm a chartered accountant. I finished 4 years of the CA course. I came out of the course. Even I did not know what to do with the money. I have studied what is a mutual fund. I have studied what is a share, but I don't know what to do. So financial literacy is something which is very, very important. And I'll tell you why it's important is because you have to start at a very, very young age for you to truly attain the full benefit of it. Now, let me ask you all a question, and you can just put the answer in the chat box. When do you think normally people retire? At what age do you think people normally retire? The general government age is considered to be 60 years. So 60 years is the normal age that everybody thinks of. Maybe if you're a professional, you may say earlier. So some people are saying 60, some people are saying 50, 63, 58. We are getting a variety of answers. Majority is 60. Now, what I'm going to do in the course, I'm not going to answer this question yet. I just wanted to get an idea of what you all are thinking. It's the same thing even when I had the thought process, probably when I was younger as well. So through the course of the presentation, I'm going to tell you certain key tips which are very, very important as far as investing is concerned. And we will also address the question of, is it possible for you to consider retiring at an age of 40, at an age of 45? Normally, you would have heard that people will peak in their career. At the age of 45 only, you'll be peaking, you'll be making so much money, all that. But here I am telling you that you can retire at that age. So is it possible at all? Is it just a catchy title that I'm using so that I can get more people here? We'll address that also in the course of the presentation. So first of all, let's start by understanding why you need to invest at all. Why is investment very, very critical? Because we tend to think that we earn, we spend, we are happy. But is that enough at all? There are certain things known as the financial freedom index. So we can split it into 5 levels, my dear. The first level is financial dependence. I'm a student either in school or in college. So I depend on my parents' earnings, or I'm very early stages of my career. So I depend on my parents' support. So only when they support me, I am able to earn money. I am able to even survive. It is because it is known as financial dependence. Then subsequently, it is known as self-sufficiency. I earn enough salary to address my needs. So I am living from salary to salary. Month on month, I'm living on a salary to salary. Then you call the next stage financial stability, where not only I am earning money, I have some buffer also. And that buffer, I can use it for my certain other expenses. I want to have a cook, I want to have a maid, I want to have certain support, I want to give my my spouse certain extra money or my children extra money. That is known as financial stability. Then you come to the next level known as financial flexibility, which means I have enough money to start spending on discretionary expenditure. I want to go travel to the US. I want to go on a family vacation. I want to buy a PlayStation, or I want to buy a TV. All of this will come with financial flexibility. And finally, you have something known as financial independence. That means I no longer need to work at all. I don't need to work at all. The salary is not something that I depend on. So why I'm covering this at the start is because I want you to know what are the levels that you will be reaching before you can consider retirement. So unless you're at that 5th stage of financial independence, normally retirement is not something that you advise. So let us go with the first tip. How many of you know who is this on the screen? If you know, you can put it in the chat box. This gentleman who's there on the screen is a very, very famous person. His name is, of course, Warren Buffett. And Warren Buffett is one of the most leading investors in the world today. Now, the first tip, as you can see on the screen, is to invest early. Why am I saying that? You see, Warren Buffett, he started investing at the age of 11. And then he still says today, I started very late at the age of 11. I was very late to investing. So the most critical tip of investing is always to start early. At the age of 20, 21, etc., you will be able to truly see the benefits of investing because of something known as compounding. Over a long period of time, over a period of 20, 30 years, 40 years, 50 years, you will find that the money that you're investing today, even if it is 1,000 rupees, even if it is 1,000, today, if I go to Satyam, I have to buy the movie ticket. That's going to cost around 200 rupees. Then I'm going to buy popcorn there. That will cost another 150 rupees. Then after that, parking charges today, very, very expensive for some reason. So that's going to cost you at least another 150 rupees. So already for watching one movie, minimum 500 rupees you have spent. Then of course your friends will say, come, let us go have lunch together. We'll have dinner together, etc. So that's another 200, 300 rupees. So for one movie, let's assume you're spending close to 1,000. If that same 1,000 rupees you are going to invest month on month or week on week, whatever is comfortable for you, you will start seeing the benefits of it over a period of time. Now, let me give you an example over here. You see, the stock market you can see over here is the Sensex that I've shared on the screen. The Sensex way back in 1992 or in 1990 was a simple value of 1,400 to 4,000. It ranged in this. At the peak in 1992, it was at 4,000. Today, the markets are at around 60,000. Today, it's at around 58,000 something. And it's been hovering around 60,000 for some time now, till the last 1 week where we saw a crash happening in the market, or a fall. I will not say crash, it's been a fall. But if you had invested 1 lakh rupees in 1995, 1996, when the market is at 7,000, today you would have got a 600% returns on it. 600, that is unheard of. You will never get the sort of returns anywhere else. 600%. So that means starting early is very, very critical. Those persons who waited, they waited, okay, we'll wait till 2000, we'll get some comfort. I want to first enjoy, I want to spend some money. Then after a few years, we will see. All of a sudden, from 600%, it has fallen to 400%. If you waited till 2015, it has further fallen down to 100%. And if you waited till 2020 or 2021, you will be hardly getting 10% or 8%. And look at the sort of fall that is happening. Every 8 to 10 years, the fall is happening by almost 100%, etc. So always start early, do not delay. And for the fear, I know that there's a specific reason why I put this photo here. This person, if people are not aware, his name is Harshad Mehta. And when I say Harshad Mehta, automatically people would have heard of the name. Who's this person? They'll know some scam he did, some stock market related scam he did. So this happened way back in 1992. And in 1992, he came out with a very, very famous scam. And he was one of the most leading investors in India. And once that scam broke out, where it was some fraudulent transactions were happening, he was manipulating the market. When all of this news broke out, you found that the market crashed. You look at the 1992, there's a small blip over here between 1990 and 1995. This was considered to be one of the biggest crashes that till today, we all talk about Harshad Mehta, 3-4 movies they made in the last 1 year about him. So he is still a big personality. He is considered to make the market crash. But you look at the larger picture today, this small crash is nothing. So that brings me to a very, very important point, is that over a long period of time, when you invest early, these sort of market crashes, they're bound to happen. You see in 1995, this Harshad Mehta crash. In 2007, there was, of course, the subprime crisis where huge companies, they went under. In the US, there was a recession. Then subsequently, COVID happened in 2019. But despite all this, the market is only growing up. So my dear friends, always learn to invest early and take the benefits of the market. The second most important thing is to research and study. Research is, of course, very key component in whatever you do. But keeping updated and researching thoroughly is very important in the stock market. If you're going to invest in shares, that means you need to study the company. India is a developing market. That means our markets, our Sensex,
is not strong enough, robust enough to sustain by itself independently. What do I mean by that? That means if there's a market fall in the US, if there's a market fall in the UK or any of the established markets, then even our Indian Sensex, even our Indian markets will also crash at the same time. So my dear friends, please note that you must study the companies, you must study what is happening globally before you go ahead and invest. Many of you may have been reading that there is a chance that Russia may invade Ukraine. So there is a potential war that is there in sight. UK have said that they will send their troops. US have said they will send their troops. They have made an announcement that this is a risk. So when all this happens, suddenly the market becomes volatile. It's going to start crashing. Tomorrow is a budget day. I don't know how many of you are aware. 1st of February is the budget day for India. Our Honorable Finance Minister is going to come out and read the budget. And therefore, you're going to find that this will also impact the markets. If the budget is what is expected, or it is an excellent budget in the minds of the majority, you will find the markets will grow up. When you find the budget does not meet the certain requirements, even though it may be a good budget from the infrastructure angle, etc., but when it does not meet the certain expectations of the investors, the markets will crash or it may go down. So all these are certain developments that you must constantly keep updated about. So what is the risk of not keeping updated? Now, there are two companies that I have put on your screen over here. The very famous Satyam. I don't know how many of you have heard of Satyam Infotech, but it was considered to be one of the crown jewels of the Indian IT in the infotech field. It was considered to be one of the best companies. They were working with FIFA. They were working with all the global reputed brands. They were listed in the US stock market. That's how big the company was. And the company, the share prices was so high. You look at the share price here. It's the one on top over here. It's at 300 rupees when 2008, at the end of 2008. Then all of a sudden in 2009 January, the CEO of the company, Ramalinga Raju, made a public announcement saying that I feel like I'm sitting on a tiger and I'm riding a tiger and anytime I will fall and be eaten. Nobody understood what that meant. Then it came out there are a lot of fraudulent activities happening in the company. And you can see over here the share of the company, the moment that announced, they've gone from 300 all the way down to 30 rupees. In fact, at one point of time, it was at 2 rupees. All of this happened in a span of 2.5 months. So therefore, what do I mean by that? My point here is this: studying the company, understanding the fundamentals, knowing if the management, the tone at the top, as they say, who are the people at the top? I'm going to invest in a company, very good price it is there. I want to know it's an excellent company, so much money they are making. Who are all the directors of the company? Oh, the directors, they're Osama bin Laden, Saddam Hussein, it is one more Dawood Ibrahim. All of these people are the directors of the company. But very good company, so much money they're making. Is it a wise investment? So you would normally advise against these investments because it is a risky tone at the top. So the management, the sanctity of the management, the reputation and integrity of the management may be at question. So you may choose not to invest in a company like that. So that's the level of investigation that you need to do. That's the level of research that you need to do when it comes to investing. Of course, when I talk about research, one thing I'm sure that all of you must be thinking of, so I have to cover this, is cryptocurrencies. I'm sure many of you would have been discussing it amongst yourselves in your circles. You would have been researching about it. Is it a safe investment? Is it a wise investment? There's so much volatility. Again, last 2 weeks, crypto has been falling very, very sharply. So here I have to definitely share my opinion first, which is I am not completely convinced by crypto. I know that there is a future for blockchain, but whether crypto has a role to play, I'm still not convinced. But then again, there's so much volatility, there's a chance the prices will grow up substantially, the prices may fall. So should you invest in crypto, yes or no? My dear friends, here's my advice. Keep it as a small portion of your investable surplus, whatever you have. Keep a very small portion, 5%, 10%, whatever you think is reasonable, as a gambling person. So yeah, I would say it is a gamble because it is still not established. When the price goes up 300% because somebody tweeted about it, Elon Musk talks about, one coin which is made for a joke purpose. The crypto coin called Dogecoin was made for a joke. Then Elon Musk tweeted about it. Oh, this is a great coin. Then all of a sudden it's gone up by 300 to 400%. We just saw the Indian Sensex over a course of 30 years. It has gone up by 600% in 30 years. Here in a span of 2 days, it has gone up 300%. So therefore, the price will go up, but at the same time, the price will crash also largely. So please be prepared when you are investing in cryptocurrency. My suggestion, it is still not an established investment option. It is what I would say a gambling investment. So if you have a certain amount of money to gamble, put it on that, but be careful about it. So what if you are busy and I don't have time to research? I'm a very busy person. I'm a IT professional. I'm a lawyer. I'm someone who does not understand how to evaluate a company. Abhishek, you are telling me to research, but I don't have the time. I don't have the knowledge to research. What should I do? Should I hold on to the money? So here is a very, very important quote that many of you would have heard. Cash is king. Repeatedly, people say cash is king, cash is king. So is cash really the king? It is only the king in smaller quantities. What do I mean by that? Cash is something that does not appreciate. It does not even stagnate. It only depreciates. Do not hold cash for too long. Now in the screen, you can see a photo of 3 chips packets. I'm sure we are all fans of Lay's packets, so we would have all been eating it. Somehow, no, country inflation gone up 9%, 8%, 7%, whatever it is, that Lay's packet is still 10 rupees only. When I was in school, also 10 rupees. Now also it is 10 rupees, even after around, you take it 10, 12 years, it is still 10 rupees. When every price is going up, how they manage to keep the same chips packet at 10 rupees? See, packet size is the same, but the chips quantity is much lesser. My dear friends, why I'm talking about chips when it comes to cash is that cash is exactly like that. That same 10 rupees, you would have got maybe 30, 40 chips 10 years back. Today, you're getting only 10 chips. I'm talking simple thing like a chips packet, but the same holds good for everything. So where you're not sure, keep enough cash only to be liquid, emergencies, medical emergencies. I need to address something urgently. I'm going to have certain expenditure in the next few months. So I need to keep certain cash. When I say cash, I mean even amount in your bank. So your cash and your bank, please keep only for the purposes of emergencies and things that you need to spend in the short future, that you can see. So one for unforeseen expenses, some liquidity, some for foreseeable expenses, that liquidity, but not too much beyond that. That's a very, very important thing to remember. So this is a very interesting thing that you can see on the screen. You see, people who are familiar with chess know that the queen is the most powerful coin on the chess table. So the queen is what we say, assets is like your queen. They will give birth to kings. Kings are where your cash flow, where you generate cash flow regularly. You need the king to win the game. If you lose your king, you lose. So the powerful thing is the queen, but you also need the king. An asset which does not generate cash flow may not be ideal if you don't have liquidity. I have a land. That land is excellent. It's a very good investment. But the land itself does not generate income for me. So if I depend on the asset, I don't have a salary income. I don't have a business. I'm not a professional. I have certain money. Suddenly I decide, okay, somebody told me land is great. I'm going buying land. But what I'll do with the land? Tomorrow I need to feed myself. Tomorrow I need to feed my family. I need to pay rent. That land is not going to generate income. So you need first and foremost, you need liquidity. For that, you need an asset that generates cash flow. And ultimately, the cash flow will lead to cash. So please note that the cash is the pawn on your table. It is the ultimate thing that you're going to have. But cash itself is not always king. It is king only in smaller quantities. The next important thing, be ready to diversify. You would have all heard this 100 times. I think I heard it 1,000 times when I was a child itself. I did not know what was the meaning, but I heard the quote. Don't put all your eggs in one basket. Don't put all your eggs in one basket. What does that mean? I think when you come to investments, you'll truly appreciate that quote, because you tend to get carried away. Oh, this is a very successful investment. I put in crypto. I put 10 rupees. Today I have become a millionaire. Sir, that tomorrow you can lose that entire million. That 10 rupees also will be gone. Similarly, I put everything in shares. Share market is doing well. Abhishek said 600% increase. I am going to put in shares. And then tomorrow you need certain money for certain expenses. And the market crashes because of World War III. So all your money is gone. So my dear friends, what does this mean? You need to diversify. Especially in India, you have a variety of options. You have shares, you have mutual funds, you have something known as fixed deposit, you have a savings bank, you also have government schemes like public provident fund, your sovereign gold bond, so many options. Of course, the rates are going to vary naturally. If you put in a share, the possible return that you're getting, potential upside, is much higher as with the downside. Whereas if you put in a fixed deposit, you'll get a 5%. If you put in a PPF, you get a 7% that is tax-free. So certain drawbacks are there, but certain benefits are also there. It gives you stability. So even if the market crashes, I know my PPF is there. I know my fixed deposit is there. I know I'm going to get a certain stable income for me at every point of time. So my dear friends, next important thing, once you join a job, you start investing, learn to diversify. Put your money across multiple asset classes. So as your income grows up, so will your disposable income, which means you need to increase your investments and start spreading it out over a course of various assets. Now, another thing I get asked very commonly, especially by people who are students or people who are new in employment, is that I don't earn that much money. You're telling me to invest. That much I don't have to invest. My dear friends, there's something known as SIP, systematic investment plans, which means if you invest a regular sum of money on a basis, even might be 1,000 rupees, even might be 500 rupees, whatever minimum you want to invest, please do invest, but do it on a regular basis. So automatically it will get debited from your account every month. 1,000 rupees is going, 2,000 rupees is going, 3,000 is going, whatever. You fix whatever you are comfortable with. Estimate all your expenses, estimate your income, minus it, whatever difference is there, that amount at least you put it. So my dear friends, you can invest even 500 rupees per month. There's nothing you have to invest 10 lakhs today. There's nothing like that. You put whatever you can, but definitely keep putting some money, and over a period of time, you can increase it. The next very important thing, as I already covered earlier, patience and emotional control is extremely important when it comes to investing. Some days you are going to wake up and suddenly market will crash. You'll think, whose face did I see in the morning? All these thought process will come, why it is happening. Yesterday only I put money. Today it has already crashed the market. Oh my God, why did I do it? All that. It's very important for you to remain very stable and calm. You see, Benjamin Graham, this person was even Warren Buffett's guru. Warren Buffett is almost 90 years old today. That person's guru is known as Benjamin Graham, and his book, The Intelligent Investor, it is called. For people who want to get into investing, you can note it down. It's called The Intelligent Investor by Benjamin Graham. This book is still very relevant today. That Benjamin Graham said this very, very famous quote. He said, in the end, how your investments behave is not as important as how you behave, which means when the markets are crashing, you need to be stable. Investments will behave differently. That doesn't matter, but you have to be calm. You need to have the confidence. The first 4 tips that I've told you, you have followed all those tips. You've ensured that you've done the research. You have ensured you have invested early when the price was already low. You have ensured that you have diversified your investment. So even if something happens bad, you have the security of something else to come and save you. So eventually when the market rises, ultimately you will still stand to gain. So you need to be patient in the face of chaos. You take something simple like Amazon today. We all see Amazon. Jeff Bezos, we see, he's talking about going to space. He wants to start sending commercial transport. People can go to space and they can visit. This person, he started Amazon in 1994. And for 9 years, for 9 long years, the company did not make any profit at all. It was a loss-making company, my dear friends, for 9 years. So therefore, when you talk about a person who needs patience, today, 20 to 30 years after he started Amazon, he is the wealthiest person in the entire world. That's the difference. That patience of 9 years, he decided this is the future. I am investing not for today. I'm not investing for tomorrow. I'm investing for 15 to 20 years later. and he is reaping the benefits of this patience and the investments that he made at the time. So you can also do it, maybe not at the level of Jeff Bezos, but at a smaller level, enough to satisfy you and your family needs. So it's very important for you to stay calm, to stay in control. The moment the market crashes, don't be tensed. Oh no, I have to sell whatever I have before it crashes further. No, you are having your steady income. You are having your security. So this is only for you to keep growing your investments. Ultimately, the market will recover. Do not worry. Don't get disturbed by the daily movements. You take Eicher Motors, the company that makes Royal Enfield. All the boys, I'm sure they'll be very, very happy to hear about Royal Enfield and how much sound it makes when they're driving, etc. So, okay, right. So the Eicher Motors is the company that makes Royal Enfield. And in 1998, it was at 9 rupees per share. If you wanted to buy one share of that company, it was 9 rupees. In 2018, price per share was 23,000, my dear friends. Imagine you bought a share, you had some 10 rupees extra, you wanted to buy Lay's packet, you decided I'm on diet, I'm not buying. Instead of that, you went and bought Eicher Motors. Today, that one share, that one Lay's packet is worth 23,000, my dear friends. That is the impact of compounding. That is the impact of not letting the daily movements of the stock market disturb it. Same thing happened with Kotak Mahindra. Same thing happened with many of the leading companies. So these are known as multi-baggers. It's very hard to identify them. Not every share is going to grow like this, but you will know that patience will always be rewarded in the stock market if fundamentally the research you have done, fundamentally the company is strong. So this is one of, again, Warren Buffett's one of his very famous quotes. When the market is crashing, we simply attempt to be fearful when others are greedy, and we learn to be greedy when others are fearful. When the market is going up, everyone is tempted to invest heavily. But if you are fearful, you're a little careful about your investments. And at the same time, when the market crashes, everyone wants to sell. They want to save the value of their investment. If you are brave enough to invest, you may start to see the benefits of it. The next very important point, protect yourself with insurance and medical care. Mediclaim is a very important expenditure. Life insurance is a very important expenditure. Today, you may have seen the Economic Times. There's a supplement called Wealth. Every Monday it comes. Today, the Wealth is talking about insurance care and how it is very, very important. So having assets is important. Having enough to protect yourself from certain sudden outflows, sudden expenditure, or sudden losses in incomes is also very, very important. Today, medical care is very, very expensive. Even in Chennai, even in all the cities in India, medical care is very, very expensive. So having a mediclaim, suddenly something happens, you want to keep your family protected. You're the single owner, you're a single bread earner in the family, or your wife does not earn as much as you. You have many children, you want to protect all of them. So in all of these cases, if something happens to that one person, then you need to have the protection, either in life insurance or in medical care, so that you recover and they're all able to still sustain without this income that you are getting for a certain temporal period of time. So invest in Medicare, medical care, Mediclaim, invest in life insurance. Both are much cheaper when you are younger. Every 10 years, from 20 to 30, it's very, very cheap. From 30 onwards, the price starts going up. Once you're at 40, 45, 50, etc., and you decide then that you want to take Mediclaim, you want to take life insurance, you have to do 100 tests. The cost of the premium is very, very high. So you start early, you're well protected over a long period of time. So that's a very, very important thing to consider. And finally, the last and most important tip is financial independence, retire early. My dear friends, I don't want to get too much in detail about this, but as I told you at the start, you can plan to retire early as well. Retirement is not an age. Retirement is not a number. Retirement is a mindset. When can you say that you retire? You can say that you retire when you meet your financial goals, when you have enough money to live off, that you don't need to earn more in the future. It's a simple calculation, actually. Now, what I'm going to do is I'm going to share in the chat box a link. This link is actually the link for anybody who wants to try this calculation. I will try to share my screen also so that we can do the calculation. Now you can see on my screen, This is the link to whatever I have just sent in the chat box. Is anybody got the link? Oh, okay, I've sent it now. You would have got it in the chat box. Now, this link is a simple calculator of how much you need to save, how much you need to invest if you want to retire early. So let's take an example. Now, my current monthly expenses. What are my current monthly expenses? How much will I incur? So I have estimated it to be 50,000 here. It may be much lesser actually. So this is a more, what do you say, optimistic or rather a conservative approach, saying that I am incurring so much expenses. But I would say normally a person who just starts his job at the age of maybe 20, 21, you probably will be incurring somewhere between 30 to 50,000. So I'm going to put 40,000 is your monthly expenditure. So let's assume your current age when you get your first job is going to be age of 21. Now, when they ask retirement age over here, say, what is your ideal age of retirement? So if you want to be very, very optimistic, no, I want to retire when I'm 30. I want to retire when I'm 31. So let's say 31. Expected lifespan till what age we will live? I would say if you don't have any bad habits, if you're not having any health issues, likelihood is between 85 to 90 is the length of age that you will live to. So let us say my age that I expect that I will live up to the age of 90. Now let us come to what is my current value of existing investments. Let us take it zero. Let's assume I don't have any investment. I'm starting afresh today. Inflation today is around 7%. And let's assume the returns that I'm going to get is maybe, 9.5 to 10% or 12%. The markets give a return of around 12%. Your fixed investments also give a return of 7.5%. So I'm going to take little optimistic of 12% investment. Now here is the calculation. This for how many years I need to have income is for 59 years. My monthly expenses, it is estimated based on the inflation over here in the future. So therefore, I have only 10 years now because I am at the 21. I want to retire at the age of 31. So how much do I need to invest per month? I need to be investing. If I want to retire at the age of 31, then I need to be investing per month of 1,23,000. You may not even earn that much salary. So forget it. 31 is a very, 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 very optimistic age to retire. But at the same time, let us take another example. Instead of saying I will retire at the age of 31, let's be more reasonable. I will retire at the age of 45. So now, if I'm going to retire at the age of 45, now my inflation is so much. Post-retirement, let us take, I have the same thing. And suddenly you will find that my monthly investment has more than half, it has dropped to 57,000. 57,000 may still be slightly higher because when you start off a job, it's very unlikely that you're going to earn so much income, so much salary. You will get 57,000 salary, highly unlikely. At the same time, even if you get that much salary, you can't save the entire salary. You're going to have certain expenses. So how do you go about this financial independence, retire early? My dear friends, there are two options over here. Either you extend your age of retirement, or alternatively, that expenses, monthly expenses that I put at the start, you reduce it. And that is the entire concept of financial independence, retire early. People tend to estimate their expenses to be higher and higher, and they meet those expenses also. The concept of retiring early is based on cutting your expenses. So this 40,000 maybe, let's assume 20,000 is rent. Balance 20,000 what? I'm having certain expenses. I want to go out with my friends. I want to go and watch movies. I want to do this. I want to do that. I want to cook. I want a maid in my house. I need all these support stuff. So therefore, I have 40,000 because I have to pay all of them that money. So what if I say, I don't need a cook, I'll cook myself. I won't eat out, I'll always carry my lunch, I'll pack it from the house and come. My dear friends, it is highly possible for you to reduce these expenses from 40,000 to even 30,000. So you reduce it to 30,000, all of a sudden you're going to find from 58,000, your monthly investments has come down to now 42,000. So you can play with these numbers. These numbers are sacrosanct. If you hit these numbers, my dear friends, you can confidently retire at the age that you have specified over there. And take not my word, there are multiple people who have successfully retired even at the age of 31 and 32. I will even share certain articles with you or certain persons with you, and you can follow them. And you will find that there is this FIRE, financial independence, retire early, is called FIRE. It is the short form for FIRE. This FIRE concept is not something new. It has been around for almost 20, 30 years. There's a huge following for this now. Suddenly it has been picking up ever since COVID. In fact, since many people are now working from home, they're staying at home, they're gone to their hometown. People who are normally paying huge rent in cities like Bombay, Bangalore, Chennai, Delhi, Kolkata, they have all moved to the tier 2 cities. They're staying with their parents, they're staying with their family, they're saving the rent cost, they're saving the maid cost because their parents are already employed someone there. The parents are cooking and giving them food, they're saving food cost. So the savings have gone up substantially. Suddenly, the concept of retiring early has started gaining a lot of traction. You can follow this person I have shared in the chat box. His name is Mr. Money Mustache. He's a very, very famous person who very advocates for this financial independence, retire early concept. And he writes regularly, almost every other day, every 2 days, he writes an article on what are the latest developments, how he retired early, how he retired at the age of 30, 32, and then you completely spending time with your family. And when I say retire, does not mean you give up life, because at the age of 32, if you retire, what are you going to do with your time? You don't know what to do with the time. Retirement here merely means a mindset. It means I don't need to worry. I don't have to depend on that salary. I have the security to live my entire life comfortably. So therefore, I can continue to work. I can continue to do freelancing. I can continue to do whatever I want. But I have the security that I've already achieved my goals and my targets. My dear friends, that is the concept of financial independence. I've shared the calculator with you. You please work out how much expenses you estimate. When you want to retire, you work out and you can decide how you want to plan about your investments accordingly. And finally, before I wrap up, the final most important tip, always seek professional help. And I don't think everyone can be an expert in everything. So if you are not someone who's comfortable with it, go meet a chartered accountant, go meet a person who's a financial advisor, take their guidance, how you want to go about, investing and retiring early, or investments in general, diversifying, tax planning, filing your returns. All of these play a very critical role when it comes to taking care of your financial literacy, taking care of your financial independence. So thank you very much for this opportunity to address on this important topic. I thank all the organizers for inviting me and giving me the privilege of addressing the students here today. Thank you very much. Back to the organizers.
Thank you so much, sir. Definitely your tips will be helpful and useful to our, all of us. So we can move ahead with a question answer section. So if you guys have any question, you can ask.
Sir,
Hello.
I have a question.
I have
Sir.
one question, sir.
Just one by one. Pratya, just go ahead.
And if anybody is more comfortable putting in the chat box also, you can feel free to do that. I'll read it out and I'll take the question. So
Yeah.
I'll leave it to you how you want to go about it. Yeah. Should I first take the question? Yeah, go ahead, sir.
Sir, I have a question.
Yeah.
Sir, as you said that the blockchain has a future, and I also completely agree with your point that crypto, and I also not convinced with it. What is your views on NFT, sir?
So I think NFT is again one of the things that come out of this. It's again an evolving concept, but for people who don't understand, let me give you an example what this NFT is based on. There's a lot of basis based on virtual reality. So virtual reality is slowly becoming actual reality today. And let us take a scenario. I work in Delhi, I work in Bombay. My wife, my children, my parents, they all stay in Chennai. And let's take even I'm working abroad also. I'm staying in some other country. I want to spend time with them. How can I do it? Today I have to do a Zoom call. I have to do a call over the phone, FaceTime. This is the best options that I have. Imagine there's going to be a situation in the future where I wear my virtual reality goggles. They wear their virtual reality goggles. All of a sudden, we find ourselves together. We are holding hands. We are walking down the road together. But what road are you walking down? What can you do? Let's say virtually we want to watch a movie together. We are going to a theater in that virtual reality. We are going to a museum in that virtual reality. We are going swimming in that virtual reality. So the rights to those movies that you watch, the rights to what are the activities you're doing in the virtual reality is trying to be sold in the form of NFT today. Still too futuristic, it's too far ahead for me to see the benefit of it. But I do understand why it is happening. I think it's an evolving concept. Definitely, we have to keep following it. Somebody has asked, next question has asked, how do you invest in bonds? So you have bonds which are government bonds, you have non-government bonds, both are available in the market. If you're going to invest in government bonds, the government will announce it, and you can do it through either a public sector bank or through your bank. You identify the bond, you tell them you want to invest in it. You fill out the form to subscribe to it. Today, everything is online. It's very, very simple. So you can just go about investing in the bonds like that. Satish has asked about index funds. It's a very important question because in the US, especially in this FIRE concept, a big part of it is investing in the index. Your index funds means which are the top performing companies in that particular Sensex or Nifty. It's called an index fund. So they select these companies who are the top performing companies and they invest in them. So when they invest, when your Nifty goes up, that means all your funds in general are going. So index funds means the fund is marked to the index. So however the index moves, your funds, your investment will also move in the same way. That also means you will not get high returns. It will be moderate returns, but it will be stable returns at the same time. These are stable companies. These are stable investments. It will move with the market. So if the market is in general going up, it will go up. Instead, if I choose to invest myself, I will find a company that has a very high chance of upside, but it also has a high chance of downside. You may not see the sort of stable returns that you want. You will find at a young age, you want high returns. You want to make money very, very quickly. But as you start maturing, as you start earning regularly, you will find that you want only moderate and stable returns. You are very happy with getting 8.5, 10% per month. You don't want the 20, 30%. It's not sustainable. At the same time, you think you'll be doubtful about it, whether who's generating 30%, etc. is highly doubtful. So having 7 to 10% normally, even 12% is considered to be very, very good returns. 7 to 12% is everyone's very, very happy with that. And those returns you'll be guaranteed when you go through your index funds. A crisp paper on financial literacy. Thank you. Thank you so much. Why is STT not considered as tax? Security transaction tax is more of a thing of tracking the market. It's like a levy. It is not a tax. It is not a direct tax. It is what we call indirect tax levied by the stock market. So therefore, it is not considered to be an income tax over here. Is this available on YouTube? I think it is being recorded and it will be uploaded. Yes.
So one doubt, sir.
Yes.
So STT was introduced for replacing long-term capital gains, no, sir? But now both the things are there, but still it is not considered a tax.
Yeah, you're absolutely, you're 100%, you're right, Deepak. In fact, today it is being taxed, your long-term capital gain is being taxed beyond 1 lakh at the rate of 10%. So these sort of questions are very valid. Dividend distribution tax was brought so that individuals are not taxed. So the company was taxed at the rate of 18%, individuals were not taxed. Then they said individuals will be taxed at the rate of 10% beyond 10 lakhs. Today, now we are all taxed. They removed dividend distribution tax. We are all being taxed at whatever income rate. So if I am going to be earning 5 crores, 6 crores, I am paying on my dividend a tax of 41%. Whereas earlier, worst case scenario used to be only 18%. So these are very, very valid questions you are asking. But to tell you the truth, I don't have the answer for it. The government has worked out the mathematical benefit or, how they want to calculate the tax, and that's how they have marked it. So maybe tomorrow's budget, you may see certain developments. So we'll wait and see, Deepak.
Sir, one more question, sir.
Yes.
Sir, why do you think that FIIs are selling in our markets, sir? If there is any tax issue for them?
So as I told you, right, one of the points that I told you is to keep updated, because there are certain rumors that come out before the budget, and based on those rumors, maybe they're expecting a capital gains tax, maybe extra tax is going to be levied on FIIs. So based on that, they take a decision, either they buy or they sell. And in this time they have chosen to sell. That itself does not indicate anything. Budget process is a highly secretive process. So these are just rumors. Nobody knows anything till it comes out tomorrow. So we'll only have to see tomorrow, Deepak. That's the truth.
Okay, sir. Thank you, sir.
Yes.
Abhishek sir, this is KK from Chennai.
Yes, sir. Yes, KK.
It's a wonderful class. I'm really thankful. We knew a lot of things from you. But my question is, one of my earlier in the COVID period, we attended one section where the consultant was being saying a financial pyramid and the percentage of the taking care of all the in the 5 pyramids. He says that this have to be invested on this have to be invested on, like 5 stages. He has said. What is your opinion about that? It is because he said that the family have to be taken care. So initially mutual fund have to be invested, then mediclaims, then banks FD and other things. Then you can go for the shares with a percentage. Then you can go for a risk, and then last finally for taking care of high risk like properties and other thing, real estate and other things. What is your opinion on that, sir?
I think generally that's a good guideline. But once again, I always say, every person's situation is different. One person may be more comfortable. They may have inherited wealth. They may have certain basic things. They may have a house, so they don't have to worry about rent. So they have more disposable income. Similarly, another person may have different form of assets. He may have revenue generating assets, so he does not have to worry about working. So all of these certain conditions, I think it has to be tailor-made to each person. In general, I would agree that majority basis, that seems to be a good trend. Whatever levels you have told correctly, KK sir, that seems to be advisable. But then again, I think each and every person has to tailor make their investments to themselves. And that's why I say there is no one shoe size that fits all. You have to take, if you are someone who's financially literate, you are very comfortable with all the equipment, you know how to go about the investments, then do it. But generally, seeking professional help in these matters is very, very important, and guidance is very, very important in reaching your own goals also. So that is my feeling, sir.
Thank you, sir. Very kind of.
Thank you, sir. Investing in golds. I think somebody has asked on investment in gold. I think, the yellow metal has a lot of affection and love in India, and more so than any other country, maybe Middle East or the Southeast Asia. These are the 3 areas where you find there's a attraction to gold. And investing in gold is generally considered to be good, because over a longer period of time, we've always seen the value of gold goes up, especially when markets are not doing well, etc. But one thing that I did not cover it in my session. It was there in my PPT. I don't know how many of you saw it. There's something known as sovereign gold bond, which was launched by the government. It's an RBI launched scheme, where if you want to buy a certificate of gold, it's effectively you're buying gold, but in the form of a certificate. So you are owner of so much gold. They're giving it a certain discounted rate, the government. And not only that, you will get 2.5% interest half yearly on this gold. Not only that, when you sell the gold, there's going to be no capital gains tax. Highly beneficial scheme that is currently being launched by the government. There are multiple series, almost 9 series are over. Soon they'll be starting the 10th series next week. So for 4 days, they'll keep it active. In that 4 days, you have to buy and invest. And it has a lock-in period of 7 to 8 years. But that's okay, because gold is a market-driven price. It's the world is going to drive the price. Nobody can manipulate the price of gold. It's very difficult to do that. So therefore, I think overall it's a good scheme. So instead of going and buying physical gold, then I have to find a locker. I have to keep it safely. Today, COVID scenario, I can't even go wear my jewelry and show off in front of anyone. If I go, then there's a risk of getting COVID. Maximum 100 people allowed in a wedding. So many, limitations are there. Suddenly, this certificate of gold authorized by the government of India seems to be an excellent investment, and no tax also they're saying. I don't have to pay capital gains tax. So this is an option today. So investing in gold is always, I would say, it's a good investment. But do consider certain developments that are happening today, and safety, security, etc. As you are having more number of qualifications, at what age did you start your investment? It's a pretty funny thing. Okay, nowadays, most young people start investing in the stock market, and they demand everyone to invest only in the stock market rather than PPF and fixed deposit. What is your view on this? There has to be, as I told you rightly, you need to diversify. Having fixed income, interest income, etc. is very, very important, because it gives you security. Your principal will never get eroded if I put in fixed deposit, if I put in PPF. Worst case scenario, I'll get interest of 5% or something, which is not bad. PPF means I'm getting 7.5% interest, completely tax-free. So these are all things you should have. You must diversify your investment. So PPF has a lock-in period, whereas FD, you can break it at any time. So if I need liquidity, I'd rather put in a FD than a PPF. But if I want to see returns that beat the market, today inflation is at 7%. If I'm putting FD and getting 5% interest, you can consider your chapter closed. You put some money in FD, it is important.
So I have hospitalization insurance, group life insurance through LIC, which covers up to what? A crore? That doesn't make sense.
Okay, I think you unmuted by mistake. Maybe.
So I have hospitalization insurance, Bajaj Allianz, I have group life insurance, I have group personal accident insurance, I have gratuity, and I have provident fund.
Okay. Okay, I think they've unmuted by mistake. I'm not sure what happened. Anyway, coming back to that question, if you're putting in FD and you're expecting to beat inflation, it's not going to happen. So you have to diversify. You keep the FD, you keep the PPF so that you have a stability. You have certain principal amount to come back to in case of any requirements. Maybe later on you have a children's wedding, you have certain expenditure, you want to buy a house, you want to maybe invest in something else. So for those purposes, it's important to have that fixed principle that generates some moderate interest and you're happy with that. But putting in the markets is important if you want to beat the inflation and you want to earn more than that. Putting in the market is the only place where you can beat the inflation, or maybe investing in a business. So these are the options that you have. Sir, what about IPO? Yes, of course. Now suddenly there's a rush for IPO. All kinds of companies are putting IPO. I would not say invest in every company that's putting an IPO. Do the research. If the company is good, invest in the company. So whether investment is good, if in case I needed my money right away or in emergency condition. So Blessy, here you need to have certain liquid amount. That's why I told you cash is king in certain scenarios. You need to have certain amount of liquidity. If you have foreseeable expense and you don't want to lock in the money, then put it in a recurring deposit, keep it in your bank in those scenarios, depending on what is the timeline. You have a certain emergency fund, and if you have a foreseeable expense, maybe I need to make an expense in 2 months. Then what can I do? Fixed deposit is saying minimum 1 year. Then it is saying that if I put PPF, it is 7-year lock-in. If I put equities, I don't know, market can crash. So what do? You put in a recurring deposit. You fix the date, 45 days, I want to put a deposit. So some interest income that you will be getting till that expense comes up. So these are certain things that you can consider. So is it good to invest in crypto for long term or short term? I think crypto is too volatile now to even consider it to be long term. If you want to do a short term investment and you want to gamble with it, I think it's something that you can consider. So is mining and trading a threat to natural environment? Yeah, I think it's definitely there. The risk is there because there's so much energy power required if you want to mine Bitcoins. Sovereign gold bonds, if sold to maturity, has capital gains. If it's sold before maturity, it has capital gains. If it is sold on maturity, there is no capital gains. Sir, how to buy stocks of big companies? You can either buy the share directly, Manivelu, or you can buy a mutual fund. You have various mutual funds. It is tailor-made to different needs. If I want to invest only in big companies, you have blue chip mutual funds, or you have large cap mutual funds. If I'm more risky, I want to try to invest in small companies, then you can put in what is called a small cap mutual funds or mixed cap, flexi cap. So many options are there in SIPs. So these are certain things you can consider. Sir, while investing, how do risks compare with potential rewards? That's what I just told you. It's a very, very wide topic, but you have to consider what are your circumstances, and based on that, you have to invest on, who you want to beat, whether it's worthwhile taking the risk. If I have so much liquidity, I don't even know what to do with the money. You can even consider putting in crypto, but markets is generally, has a track record, so people put in the market. Join SIP in earlier years for retirement or for SWP. Okay, SWP is systematic withdrawal plan. I don't want to consider, I discuss that in detail because You're all youngsters, so I don't want to talk about SWP. So I think with this, we have covered all the questions. We've gone over time a little bit also. So thank you very much to the organizers for inviting me and giving me the opportunity. Over to the organizers. Thank you very much.